this idea, you call yourself a one-handed economist who sees no chance of inflation, that deflation is our future. So speak about that a little bit.
Well, I think the big problem is debt. There's $55 trillion worth of dollar-denominated debt. When you go around the world and add up the debt, it comes to about $200 trillion. When the government ran out of steam pushing home ownership debt, they started moving over to students and trying to push student loans. Those are now up to $1 trillion. When you add $84 trillion worth of unfunded liabilities of the federal government, when you look at perhaps $1 quadrillion worth of what I call IOU ifs, which are derivatives, I think the debt burden is so great that it's unpayable no matter what anyone does, including governments and central banks. So I think it's going to go the way of all over-indebtedness, which is deflation. I think we've got some signs of it as well in the background. But so far, the central banks have been pretty successful in keeping things about flat.
Okay, so you're talking about debt, the enormous debts, the fact that debts that can't be paid won't be paid, and that bonds default, that goes belly up, and there's this depression, deflation going on. And there's a background with this also.
Inflation of base money. But my argument goes a lot deeper than that. I think the banks don't want to go bankrupt. And a lot of people said, in fact, Bernanke himself promised that he would drop money from helicopters. And is that really what they've been doing? Well, in 2008, they pretty much did that. They supported all their buddies, willy-nilly during that period. But very rapidly thereafter, they traded all that debt for U.S. government bonds, government guaranteed mortgages. So they're doing the same thing the Fed's always been doing, which is buying the safest possible debt. They're not going to go up and buy all the bad corporate debt or all the bad mortgages that are owned by the banks. Now, something that I more or less anticipated, that I think shocked a lot of people, was what happened in Cyprus. I mean, where was all the money printing? Where was the central bank, the ECB coming in, on a white horse saying, we're the lenders of last resort? Where's the money dropping your bank accounts? In other words, we're not bailing you out, we're taking your money. These are still bankers, and they don't want to go under, they don't want to go bankrupt, they're not giving money away, they want to be paid back. I think eventually the same thing is going to happen in the United States, that there's no such thing as magic money, no such thing as infinite credit. And when this thing rolls, it's going to be a sight to see. Okay, well, that's a really good point. I want to focus on this Cyprus situation as you described it here, because, and to give some context here, what you're saying is that the reason we've had these programs like quantitative easing is because when when bonds are due to be rolled over and matured, there's not enough economic growth to support a normal functioning bond market. So the government has got to come in and buy their own bonds. They've got to print money and buy their own bonds. And they're doing this in the hundreds of, trillions of dollars, because there is this ongoing deflationary rollover of these economies. And so for those who say, as I just described, that there are countervailing inflation evidence in the consumer price index, your point, I just want to repeat the point, is at some point you end up at a Cyprus, where the banks just say, forget it, it's a bail-in, we're just taking the assets, and that's the risk, is that type of Cyprus-like bail-in or wealth confiscation spreads throughout Europe and spreads around the world, correct? Yes, in fact, the people who run Europe have already warned Spain and Portugal and Ireland and Greece, look, if this happens to you, we're going to raid depositors' accounts. So, will the FDIC pay back everybody? I don't think so. The Fed has said several times that they want the government to get their houses in order so they can shore up the banks here in the United States. I don't think the Fed is going to do it, and I don't think the FDIC can do it. So I think we're in a real crisis period. And Cyprus was a little glimpse into the future, just like 2008 to me was a glimpse into the future. Shot across the bow, told us what it's going to be like when things do implode. Last year, when Bernanke came out and said, our QE policy is designed to keep long-term interest rates down. Well, they had already started up in the summer of 2012. They've been soaring ever since he made that comment. So obviously their policies aren't working as designed. All of the machinations that they're going through are leading to a weaker and weaker and weaker situation with greater and greater debt. The more they keep the bad guys liquefied, the more debt expands. And you're getting some of these things like we talked about before, like student loan debt and private equity companies, paying themselves through more and more ridiculous bonds that aren't going to be paid off. So the situation gets worse and worse and worse, and I don't think they can ultimately control it. I think ultimately the market is going to start demanding higher rates. And this happens in countries that are in trouble. It certainly happened in Greece before things blew up there. So rising interest rates to me are not the result of an extremely healthy economy, which is what most economists think. I don't think they're an indication that hyperinflation is coming, which is what most of the bears think. I think the rise in rates now that surprised the Fed and virtually everyone else are the early hint that all the debt's in trouble. And people are going to start demanding higher rates because they're going to start worrying about principal. Now, this is pretty much off the radar because if you look at the sentiment indicators in the U.S. stock market, they are off the charts and have been for 5 months. In fact, we follow up to 22 different sentiment indicators, every one of which reached extreme record highs or matched record highs being 2007 and 2000 in the past 4 months. So we're back at another 2000 juncture, 2007 juncture when people are absolutely optimistic about potential stock market gains. They're buying junk bonds like crazy. In fact, even though we're off the highs in junk bond prices, the sales have continued to be very, very strong. So the optimism and confidence out there is tremendous. It's historic, and it's the same level it was in 2000 and 2007. So we've got a double whammy coming. Too much optimism means people are taking all these investments on. And the second one, as you pointed out, is the underlying system is rotten and isn't going to be able to support these debts and the interest payments, or eventually, I think, even the principal payments.
All right, let's talk about the bond market here for a second, because the rate on the 10-year bond, and this is the bedrock bond that all other mortgages and credit-related instruments kind of sit on, this 10-year bond, the government bond, whether it's the UK or the US. You know, last year we're saying they were 140, 150 on the 10-year bond. Now they're 250, 260. They're moving up. What you're saying is that, and this is interesting because we're going to tap directly into the Elliott wave phenomenon, because the Elliott wave phenomenon, or technical analysis, looks at historical chart patterns and price patterns, and there's also a bit of, how do I describe this? There's a recurring theme in human nature that you see humans tend to go through periods of enormous optimism at the top and enormous pessimism at the bottom. And so your work tries to tap into that. Do you see, Robert Prechter, just to repeat on this, you're saying that rates now have bottomed out, you're looking for rates to rise, and so therefore bond prices commensurately are on the decline, which of course has huge implications for the banks and the economies. Bob, your thoughts?
Huge implications. One thing I'm very proud of is that a year ago in the summer of 2012, Steve Hochberg, Pete Kendall, and I got together, put out our first joint special report out of Elliott Wave International here, and we said the 31-year bull market in bonds is ending. We're going to get into a very major period of rising interest rates. And as you just pointed out, this is the kiss of death. This is the black hole. When rates start to rise, this is where people start putting their money. So they stop putting it in other areas. And the higher rates go, the more it attracts money. Again, just like a black hole of magnetic force. So it's going to come out of the stock market. It's going to come out of commodities. It's going to come out of metals. It's going to come out of real estate, and everywhere just to go to borrowers who are willing to pay a higher and higher interest rate. It's very bad for the internal structure. Unfortunately, I think the monster that all the lenders, most of which are backed by the government, whether it's the Federal Reserve System or Fannie Mae, Freddie Mac, Federal Home Loan Banks, Ginnie Mae, Sallie Mae, you go right down all of these lists of agencies that have been pushing credit on the American people for all these years. And it's finally led to a point where the monster's too big to kill. And the only bullets they have are more debt. So you can't kill a debt monster with more debt. Ultimately, you know, we're going to reach an end game here shortly. And I think the extreme in optimism is one of the big signs, the warning signs that we saw before the last collapse.
All right, the legendary Bob Prechter, thanks so much for being on the Kaiser Report.